Hello, my name is Shreyas Juloori, and today I will be pitching JP Morgan. JP Morgan is the largest US bank with over $3.9 trillion in assets under management operating under various segments. It has global brand recognition with branches in US, UK, China, India, and many more, and has over 200 million accounts globally. Its current share price is $232. JP Morgan is America's bank due to it being the largest operating bank in the US. It has seasoned leadership, including Jamie Dimon, who's a CEO and director of banking, and has navigated the '08 financial crisis as a regularly consulted person by the Fed. And as you can see, under his era, revenue has consistently grown. My investment thesis is that the fact that it has an unrivaled business model which shares size and efficiency, product innovation with great AI integration to fend off fintech competitors such as Apple and Stripe in the payment processing world, macroeconomic tailwinds, financial strength such as net interest margins, and a great financial valuation. Throughout the day, I'll hammer down on the fact that everything JP Morgan is doing is to increase its margins and efficiency in industry which is such low on margins. Its business model includes asset management, banking, and credit cards. In terms of banking, in 2024, it increased its investment banking fee to 1.45%. However, it did not experience a client loss, suggesting it has a strong grip hold over the industry. Additionally, it had $90 billion in net interest margins, higher than any other US bank, and a 21% increase. Additionally, JP Morgan has streamlined processes for business reporting and cut down many middle management jobs, reducing labor costs and increasing efficiency. Additionally, it has built 100 new branches in low-income areas, expanding its consumer base. More importantly, JP Morgan has a huge credit card industry, which America loves. According to Forbes, Chase Sapphire is America's favorite credit card due to the fact that it offers various travel and restaurant and shopping benefits. JP Morgan has various revenue drivers, but namely its consumer banking and commercial banking that lead the way, leading to a net income of over $14 billion. Its industry outlook is very promising. As we see on the graph on the left, public bank continue to gain market share due to the fact that regional banks and private banks can't offer the same competitive rates due to lower amount of capital. Additionally, credit card merchant processing fees have increased to nearly $3 trillion due to the fact that credit becomes the more and more the increasingly preferred method of payment for many American consumers. If we look at its stock performance, the XLF Financial Sector ETF has similar performance to JP Morgan within the last 1 to 2 years. However, we noticed a drastic dip in the early 2025, which is where we are right now. This $60 to $70 dip is scary to the investors, but I'm here to say that this is what actually makes this company so lucrative, and I'll explain why later. Its competition includes Goldman Sachs, Morgan Stanley, BofA, and Citibank, all with market caps from 100 to 350 billion. Its return on equity is around 8 to 12%, while JP Morgan's is a staggering 17.3%, showing how it has extremely efficient capital allocation, and that number is only looking to increase in the future with its new cuts. Additionally, these companies' P to E hover around industry average, while JP Morgan is at a low at 11. However, for some people, that this may cause them to feel distressed and have negative consumer sentiment, investor sentiment. I believe that this actually leaves room for price appreciation of the stock. It has a great competitive positioning with a 15.3% CET1 ratio, meaning high liquidity, able to provide loans even during credit crunches, something not every bank can do. Additionally, it has great brand recognition with over 5,000 branches across the world, and it is almost too big to fail, providing investors with a margin of safety and a sort of cushion due to the fact that so many consumers and companies rely on JP Morgan. It has great product innovation and artificial intelligence in terms of capturing more market share. In fact, it has invested more in R&D in this segment than the next seven most banks combined. For instance, its TCN or tokenized collateral network is a management platform allowing institutional clients and business-to-business transactions to occur using traditional assets, which will reduce delays. Not only will TCN have the ability to eliminate risk, but it will also accelerate settlement payment processes, along with JPM coin, which is a blockchain version of that. Additionally, I want to highlight Chase Travel, which truly sets JPM apart. Chase Travel is a vertically integrated travel system such as Expedia or a kayak that JP Morgan has for people who uses its credit cards. This is due to the fact that JP Morgan did not want to pay such high fees to third-party vendors, and now with everything vertically integrated within the company, it can save money on those margins. However, this did require a significant amount of capital expenditure. It has great macroeconomic tailwinds, which are pushing it towards success. Most importantly, under the new presidential administration, regulatory regulations for M&A have significantly decreased due to corporate corporations being under lighter laws. This is extremely good because since the post-pandemic era, deal flow has decreased as we can see. Additionally, the energy sector should be specifically booming, which JPM takes a lead in due to the fact that US is subsidizing local investment in energy and data storage, which is an example exemplified by Apple's $500 billion investment inside of the US. Additionally, I have explanation for the $60 to $70 stock drop. This is because of the fact that under the new presidential administration, tariffs have been implemented, and this has caused many people to think interest will increase. If interest increase, many consumers won't want to come to banks for loans. This will significantly reduce its net interest margins. However, I don't believe this will be true due to the fact that even though tariffs have been implemented, Jeremy Powell, CEO of the Fed, chairman of the Fed, still says that they will reduce interest rates around 0.5%, as exemplified by the Taylor rule, which the Fed follows in strong adherence. This means that JP Morgan could continue to give out loans and operate at a good margin. Additionally, JP Morgan faces a few investment risks, namely its subprime credit loans and its market volatility. However, through its asset-backed securities and diversification, this should be okay. Its primary issue is its price to book value being 2.09, much higher than any other bank. However, it's always been over 1.8 in the last 10 to 15 years, and it still demonstrates consistent growth due to strong earnings and around 3% buybacks every year, like in 2024, which supports growth of the stock price. Additionally, JP Morgan has a strong commitment to the environment, and JP Morgan has spent $1.29 on green energy solutions for every high carbon activity and $1 billion investing in green ones. These allowed JP Morgan to avoid stranding assets for various environmental compliance laws around the globe and appeal to socially conscious consumers and investors. Additionally, they do a great job leveraging diversity, with 11 of the 12 board of directors members being independent, allowing minimal corruption. As we can see, shareholders here are about standard, with about 75% being institutional. It has great financials and, for instance, a low PE, as we mentioned earlier, which I believe will allow room for price appreciation. Additionally, it has strong profitability metrics, including CAGR and EPS growth, as we see in the last 3 years have grown significantly. And with its new focus on efficiency, it will continue to grow. Additionally, JPM has increasing margins, as we see under the operating margin and net interest margins, that continue to go every single year. And in its latest annual report, JP Morgan reported a decrease in days inventory outstanding and days sales outstanding, suggesting a more efficient asset turnover ratio and a higher amount of accounts receivable actually be converted to recognizable revenue, unlike any other bank, which are all increased. Next, I wanted to do an intrinsic valuation to understand the true value of the JP Morgan stock. For this, I used a discounted cash flow analysis. First, I had to project out my free cash flows. For this, I had revenue projections of nearly $400 billion by the end of the next 5 years. This means around a CAGR of 13%, which makes sense due to the high margin verticals and the technology-driven financial service company that Chase has become. Additionally, I chose to use NOPAT instead of EBITDA due to the fact that JP Morgan does not have to pay as much as 21% of corporate tax rate, which gives it a competitive advantage compared to other banks. However, this does not mean EBITDA is not that good, because the EBITDA, as we see here, as experiencing consistent growth year after year of around $10 billion. Additionally, we see that JP Morgan has invested a lot in capital expenditures, which has restrained cash flows right now. However, I believe that this will increase the return on investment with this is lucrative, as it has been in the past. Next, I want to talk about my DCF projections. I used a 5% terminal growth rate and a WACC of 13.3%, given the market volatility and the market averages. Next, I wanted to give it a 5-year runway because it is a mature company, which yielded me a present value of around $1 trillion. This, and in worst case, I used a sensitivity analysis, which showed the worst case the stock price is around $252, which gives it a high margin of safety, with the implied share price of around 331. I also wanted to do a discounted dividend model, given the fact that JP Morgan has consistent dividend payments, except during the COVID era, which did decrease the model's valuation. Additionally, I used a CAPM and cost of equity of 9.25%, which is about industry average, so investors don't have to worry about risk. Factoring all these three in, I got a target price of about $330, which is that's a 42% growth. Thank you.